So operating activities, we said, parallel income statement items. So if you look at each of the items here, you'll see that they're similar to income statement items. Cash received from customers is like sales revenue. Cash paid to suppliers is like cost of goods sold. What is the difference? The difference is that when we're looking at the income statement, we're using the rules of accrual accounting. Revenues based on when they're recognized, when they're earned and received or receivable, and expenses are recorded when they're matched up to their revenues, when you get the benefits from those expenses. When we're talking about cash flows, on the other hand, we're measuring the same things, but we're measuring them at different times. A revenue is recorded when you receive the money. That's cash received. A cash paid to supplier is recorded when you pay the money, as opposed to cost of goods sold, which is recorded when you sell the goods. So fill out activity 44 right now, and then we'll go over it. Operating activities affect what items? Current assets and current liabilities. Identify transactions that are operating. Receive cash from customers paying on account. Operating. Pay rent for the next accounting period. Operating. Receive the utility bill for this accounting period that will be paid next accounting period. Not. It's not a cash flow this period. Extend $100,000 of credit to supplier Barry for a purchase. No. We're letting Barry buy something on credit. It's not a cash flow. Now, if we would collect money from Barry, then that would be a cash flow. Receive interest payment of $8,000 from supplier Barry. Operating, even though it's interest. Supplier Barry pays off the $100,000. As we receive it from Barry, that's also operating. Now here you can see the operating section. Let's hold off on this actually. This is a good time to break. Maybe let's start this now. Okay. Now let's get it over with. I'm sorry to dangle that in front of you, but let's just get this over with. So we have what we call the indirect method. The direct method is what I showed you before, and the indirect method, the indirect method is primarily what companies actually do. And when we work in this course, we always try to give you the practical, what you're going to see in the real world. So the direct method, again, has things like cash received from customers, cash paid to suppliers. But that's optional, actually. And companies are required to do something called the indirect method. What the indirect method does is it adjusts net income. It starts with net income, adds and subtracts various items, and then arrives at cash flows from operating activities. So here you can see, for example, we have net income, add back depreciation expense, add and subtract various other items, and we wind up with net cash from operating activities. Well, this is very tricky because the idea is, we were talking before about how income and cash flow don't necessarily move together. We said you could have profits, but you might not have cash flow. This could also work in the other direction. It could work in a situation where we have a loss, a net loss on your income statement, you're in the red, but you have positive cash flow. So what this explains is this section of the cash flow statement, using the indirect method, explains to you why they're different. Explains why net income and cash flow are different. Now let me explain the difference here. Let's walk through one of these. In 2011, Southwest Airlines made $178 million in income. Very nice. But this is the interesting part. It had $1,385 million in cash flow. Look at the difference. Let me repeat the numbers. $170 million in income, $1,385 million in net operating cash flows. So the first thing that should enter your mind to ask is, why are these numbers different? Why are cash flows so much higher than net income? The answer is in these other items here. Let me show you what these are. The first one is depreciation expense. We talked about depreciation. Depreciation is an expense, but you don't have to pay for it. Depreciation expense merely increases accumulated depreciation. It does not affect cash in any way. Right? You have to pay depreciation. What is depreciation again? What was the definition of it? Do you remember? The allocation of the cost of an asset to the periods benefited. Has nothing to do with cash. So therefore, depreciation expense was subtracted in arriving at net income. Look at the income statement, it's right there. One of the things they subtracted was depreciation expense, but there was no cash flow paid. None whatsoever. There was no cash flow there. So since there was no cash flow paid, you can add it back to income. Even though we only had $178 million in income, $715 million in our expenses was depreciation. It didn't cost us anything. We didn't have to pay for it. So therefore, I'm going to add it back, because that means I had more cash flow. Now, I also had an increase in accounts receivable. What does an increase in accounts receivable have to do with cash flow? Well, if accounts receivable increased, that means that for that amount of money, you made sales that you did not collect payment for. That's why accounts receivable went up. Accounts receivable went up because you made a sale and you didn't collect the money. So we made $26 million worth of sales for which we did not collect the money. Therefore, that hurts our cash flow. Now let's look at another side of this. By the way, when that's positive, look in 2009. That was a decrease in accounts receivable. That means we collected more money than we sold by $40 million. And that improved our cash flow. Now, this is important to think about, because if you're running a business, one of the things that you may be responsible for is managing cash flow. And a key aspect of managing cash flow is collecting the bills from your customers. You make a sale, the customer now owes you money. The sooner you collect the money, the better your cash flow. Let's look at this next thing here. Other current assets. Decrease in other current assets. This means that we had previously paid for things and now we're kind of collecting them. Set that aside for a second, because other current assets is going to work the same way as accounts receivable. If it increases, then it's going to subtract it. If it decreases, it's going to improve cash flow. But let's look at another thing here. Payables. They had a huge increase in payables. What this means is that they accumulated $253 million worth of bills, which they did not pay. So if you choose not to pay your bills, follow this very carefully, please. If you choose not to pay your bills, that improves your cash flow. Right? I don't know how many people here have credit cards, but what if you decided 1 month you're not going to pay your credit card bills?
My credit rating will go.
But yeah, of course. But what's going to happen to your bank balance? Your bank balance will be higher because you didn't pay your bills. And that's exactly what this is here. You see an increase in payables for $253 million. That improved the company's cash flow. So if you're wondering, why is net income so low and cash from operations so high, the main reason is this depreciation. It's $715 million of depreciation. Aircraft is expensive. Depreciating it is very expensive. But you don't have to pay that. So therefore, your cash flow is higher. And another factor is they pay their bills more slowly. This increase in payables. So all these reconciling items, you see the overall pattern here? The overall pattern is that typically Southwest cash flow can be as much as 5 to 7 times, or even almost 10 times its income, for these reasons. And a major component here is depreciation. And by the way, this is what you look for. Usually cash flows from operations can be much, much higher than net income for a company. So their cash flows from operating activities here is created using what we call the direct method. What was the strongest year, would you say? Why do you say 2010?
Because you have the most net cash coming in.
Yeah, the cash flow here is much higher than the other 2 years. Look at that. The income is 459 million, and your cash flow is 1561. So I would say 2010. Yeah, that makes a lot of sense. The weakest year was what? 2009. Because there you have the lowest income and the lowest cash flow. And we talked about this before. They run all Boeing 737s. Okay, great. We're going to come back to 45 in a few minutes.